You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Has 2014 stock market volatility gone the way of the dinosaur? I'm DeLegge with ETFguide. Welcome to another episode of Marketplace Minute. Well, that's the news du jour, that stock market volatility is non-existent. And here's just a brief glimpse of what the media has been saying about the VIX, which measures volatility in the S&P 500. Quote, this is from Zero Hedge, the VIX tumbles to 9-month lows. Here's the Wall Street Journal. The VIX Volatility Index falls to its lowest level in over a year. Here's Reuters. Fear strikes out on Wall Street. So the dominant argument in all of these articles is how volatility has been almost non-existent. And the reason they use that or say that is because the fact that the VIX, which measures volatility, has dropped around 30% over the past 2 years. But if we take a look closer, you will see that volatility, while it sleeps, never really goes away. Just a quick example, in 2014 alone, the VIX has surged on at least 8 separate occasions, 15% or more. And in fact, July of 2014 was the 7th most volatile month for stocks, the VIX, since 1990. So volatility has not gone away. Volatility does exist, and it is, by the way, an indicator that I regularly monitor here on Marketplace Minute. And the reason for that is because it gives us an idea of what the market's mood is. Because when the market is scared, in other words, when stock market participants or investors are scared, you see a spike in the VIX, whereas when there's complacency, the VIX tends to remain pretty calm and very unnoticeable. But in this instance, for the individual investor, besides playing the VIX as a short-term opportunity when it's depressed and going long, besides that, the other part of this discussion is for the investor that wants to avoid volatility or minimize that volatility in their portfolio. How can they do that? Well, one way is by having some cash in your portfolio. Cash, as regular viewers know, is a major asset class that all well-built portfolios should have at least some exposure to. And so that's one way to hedge against higher volatility in the market. There are also ETFs that are designed to minimize stock market volatility. And I'm going to give you one ticker symbol that offers stock market exposure, but with lower volatility. That's ticker symbol VSPY. And this is a Direction Shares ETF. It aims for long exposure to S&P 500, but with lower volatility. So that's the wrap on the VIX and stock market volatility. It has not gone the way of the dinosaur. I'm DeLegge with ETFguide. Thanks for watching another episode of Marketplace Minute.